Okay, uh, lecture six, Anwar Shaikh. I think we'll stop doing this for a while, um, so people can either catch up or decide they don't want to listen to this anymore and be doing something else next week. But I think it's worth reading. I think it's important to get a kind of foundational sense, at least at a graduate level, of what's going on. And so I hope you find this useful, or at least that you'll take into account that there are alternative methods, foundational methods.
Argued that that if you think about competition within an industry, what it does is it creates a roughly equal price for the commodity A, B, and C, but because they have different methods of production, because they're vintages, new methods, old methods still coexisting, you're going to find at any moment of time a spectrum of profit rates, because the very fact that they're selling goods for roughly the same price, but they have different costs, means that profit margins and profit rates will be different. So let's suppose in industry A, the profit rate, average profit rate is down here. Industry B, that's the average here. Industry C here. And these averages are different from each other. And then I made the point that what competition does is seek out, unfortunately this doesn't show up very well on the Mac, but anyway, this is supposed to be the regulating rates of return. In one sector, it's in the middle someplace. Another sector, agriculture, will be at the end. And in a third sector, the most efficient technology with the highest returns will be up at the top. So what's equalized is the capitals that can newly enter in an industry. And those are different than the average. Obviously, if, for instance, you are, let's say, in agriculture, you can't reproduce better lands, so the entry will come in on the worst land that is still not fully utilized, and that would be at the margin of cultivation, as Ricardo calls it, down here. Perhaps in another industry, it'll be in the average, somewhere in the middle, and an industry where the best method of production is reproducible to new entries. They don't have to be new firms, just new investments. It'll be up at the top. So that equalization automatically implies that what's equalized is the type of capitals that can be reproduced by new investment, and that's quite different than the average. So we'd expect the average to be different, and we'd expect the equalization to take place for the regulating capitals. The next point I made is that this process of equalization is not to be understood as becoming equal, but rather turbulently moving up and down. So if this is a regulating capital in this industry and the other one has a regulating capital here, we'd expect to see this process of moving up and down of the regulating capital profit rates, and that means the whole spectrum will move up and down also at the same point. Are there any questions about that? We more or less ended here last time, a couple more points, but this was the idea of the turbulent equalization on the regulating capitals. Questions? Yeah.
There's something that I didn't get, was what is the role of the demand in the way that we can pick the regulating capital in one sector?
Very good question. Okay, so let me act it out again like it did last time. Okay, so let's suppose that this half of the class is an industry with high profit rates for the best available method of production that can be reproduced. Very important point, because it might be better land, it can't be reproduced. Let's suppose that's this capital here, and here we have another industry where there is another profit rate for the best available method of production, best generally available. Now if this method is higher, more capital is going to enter here more rapidly than it is going to enter there. They're both growing, but this one's going to accelerate, and this one's going to decelerate relative to demand. That means that the market price in the sector where supply is accelerating relative to demand is going to come down. In this sector where it's decelerating relative to demand, the price is going to come up because supply is falling relative to demand. Relative now, but they're both growing. So it's the market price that does this work, but it's the movement of supply relative to demand that does the effect on the market price. What's the effect of a falling market price? The profit rate in the regulating capital is going to go down here, it's going to go up here, and perhaps they'll overshoot and they go back and forth, but that's the process. So this takes place through an entry and exit of new capital, not firms, new investments, and that has an effect on supply relative to demand, which has an effect on price, profitability, and you bring about this equalization. Does that answer the question?
Yeah. I'm just curious if you could talk a little more about the utility of the analytical category sector.
Of the
category sector.
Sector.
Like it seems arbitrary to me.
Yeah, I'm using the term loosely, so I mean here industries, and because in different parts in the literature they're called, in the classical literature they're called different names. But let's say I'm talking about a group of firms that is producing a relatively homogeneous product. Now these same firms may be producing in many different products, so then they'd be partitioned, so to speak, in that production. Typically a plant producing one thing is different from a plant producing another. So strictly speaking, I'm speaking not of firms but of capitals producing a relatively common product in which their price competition forces them to match each other. Yeah, that's a good point. The term sector has a different meaning in IO, industrial organization, and different in input-output economics. So I'm using it in terms of industry. Yes?
You said that depending on the industry, you're going to have different regulating profit rates, basically.
Different industries will have, each industry will have a regulating set of conditions, not regulating profit rate per se, but of conditions, yes.
What are those conditions that determine the...
They are the conditions that can be reproducible to new investment. They can be expanded or contracted, but it's the best available, generally reproducible conditions. And that's the key to the secret in Ricardo's theory of rent. You know, the reason that there is rent is that all the good land near the river and near the housing and all that is taken up, then you move up further away. And you move up higher up the mountain, and there the cost is higher. But you have to do it because you cannot produce enough corn or food on the good land. When you've used that up, you keep moving up. And so the reproducible margin, which doesn't mean marginal. The reproducible margin could be a huge quantity of land. So you're only using that part of it so far. As demand expands, you move along that margin of cultivation. But that could be, it's a shelf of cultivation. The reproducible shelf happens to be, in the case of agriculture, the worst freely available reproducible land. In the case of industry, it could be something else. It could be the newest technology that is not protected by some patent or protected by some special conditions. Then that is where new investment will go. And you have to think that when firms make money, they don't have to put it back in the firm. Their goal is to make as much money as possible, and they keep doing it where they know, but we know that firms will invest in other products and other locations in other countries where the pull of profitability is. I'm going to talk about the empirical evidence on that shortly. Okay, does that make sense? Okay, so that's the basis of this idea that this equalization takes place for a particular set of capitals, say the high profit ones in this industry and the low profit ones in this industry, and they go back and forth. Then it follows from this that because the equalization is only for the regulating, necessarily have all equally distributed regulating capitals. You may have some countries who have the benefit of the higher profit rate capitals, including the regulating ones, and other countries are just hanging on in the market with less competitive capitals. So there's no implication that profit rates are equalized across regions or across countries in this framework. Now I'm going to show you that in the neoclassical framework, the exact opposite. They have to be equalized everywhere. And that's because of the way that the theory of perfect competition is constructed. Okay, so this is where we ended last time. I need now to summarize all of this, but before that I need to just remind you of the definition of the profit rate so that you can see some other further implications. The profit rate is just profit over capital. P is big profit and as aggregate profit, and K is capital. But I can divide the top and bottom by quantity of output, so I get profit per unit output, which is commonly called the profit margin, and capital per unit output, which is often called capital intensity. Okay, that's a trivial point, but it is important because if profit rates are equal, then that means a sector with higher capital intensity must have a higher profit margin. It's a necessary consequence of equalization of profit rates. So we would expect from the theory of competition that if we're looking across industries, profit margins will be higher where capital intensity is higher. Okay, so if I write that profit in one sector is equal to its profit margin over its capital intensity, and this is roughly equal to the profit rate in another sector, which is defined by the profit margin over capital intensity in sector J. If Ri and Rj are equal, then it follows that if this is bigger, so must this be in order to make them equal. In other words, what competition will do is give higher profit margins to industries that are more capital intensive. That's a result of the turbulent equalization. Okay? And you'll see this is important because you'll see the neoclassical theory, this is not possible. Hence, when you see it, you think, oh, well, this is proof of imperfect competition or absence of competition. But in real competition, it's a necessary consequence of competition. So with that, let me go to the summary. Is that clear? Yeah? Just do it as I can. So the first step was to talk about price-cutting behavior is the first characteristic of real competition. Firms cut prices. In order to be able to continue to cut prices, they have to be able to cut costs. So there's a constant battle about cost cutting. And of course, cost cutting means pushing down wages if you can, raising length and intensity of the working day if you can, and if not, or within those limits, mechanizing, in changing technology. Okay, these are very familiar if you look at the business literature, and we're going to do that shortly. Then, within one industry, there's going to be a regulating capital, which is the price leader. And that's the one that's on whom competition forces a common price, and the other firms have to match that price, more or less. And so that means that the price of the firms are tied to the leader's price. If the leader is P star, then the other firms' prices have to match if they're going to stay in the game. They don't have to be exactly equal, but they can't get too far away. The regulating capitals are the price leaders because they're the ones able to expand and create long-run supply. Non-regulating capitals, therefore, have to be the price followers. And the consequence of being a price follower is that the price is given to you so that what competition gives you, in effect, is a profit margin which is consistent with your unit costs. That is to say, price followers will have profit margins which will be generally lower than those of regulating capitals because their costs will be higher. So we'd expect to see a spectrum of profit margins related to costs. The higher the cost, the lower the profit margin. The lowest cost conditions of production have the highest sustainable rate of profit in the face of price-cutting behavior. The reason they are the regulating capitals is because their lower cost gives them a bigger cushion and they can survive with a higher probability in competition. Very important point. It doesn't follow that they will survive. But like they're better defended and have more capabilities of offense because they can cut their price. If their costs are lower, they have more room to cut their price and drive out their competitors. Again, that follows purely from the logic of things. Firms constantly cut costs and develop new technologies because they are price-cutting firms, and one of the ways you cut costs is to push wages down or increase the length and intensity of the working day, or go where labor is cheaper, which is a very important point, and to develop new technology. It follows that you're going to get a spectrum of unit costs and capital intensities within an industry as older technologies are scrapped and new ones brought in. So that's that box I keep showing you. Within an industry, there's a range of profit margins and profit rates. follows purely from the theory of competition, given the existence of vintages of technology. As new technologies come in, they displace old ones, but there's always a range. There's never any moment where they're all alike, except perhaps the first type of good in a particular industry. For many years, I had this wonderful computer, which was called the Osborne. It was the first portable computer. It was about the size of an old-fashioned sewing machine, and it weighed 28 pounds, and the screen was about this big, and the whole memory was 64K. Not 64 megabytes, 64 kilobytes. It was a thing of beauty because you could pick it up and walk around with it. I ended up giving it to the People's Republic of China when I visited because they had no computers at that time, 1985. But then, at that moment, it was the only portable computer, and there was therefore no other. Within months, another computer came out, another company came out, which reverse engineered everything, took Osborne's idea, made it into something quite different, and that computer was selling for much less. Osborne was bankrupt within a year, but he was the first. And then that led to a series of portable computers, and what you see now came from Adam Osborne's original portable computer. But ever since then, there's been a spectrum of producers and different methods, because each new method soon becomes middle-aged and then old as newer ones come in. Since costs differ within an industry, then profit margins will differ, because profit margins are the selling price over minus the cost over price, so you'll have unequal profit margins as long as prices are equalized. And you'll also have unequal profit rates for the same reason, because prices being equalized, if costs and capital intensities differ, you'll have unequal profit rates. And you're going to therefore expect from the theory of competition a positive correlation between profit margins, scale of production, because bigger firms tend to have lower costs, scale of capital of plant, because again, bigger firms means bigger plant, and scale of capital intensity, because typically the way you get lower costs is to become not only bigger in the sales and bigger in your plant and equipment, but bigger capital per unit output. We're going to look at the data on that. Any questions about this? These are the summaries of the points that I've already developed in competition within an industry. Okay, competition between industries. The key point is that the equalization takes place only for regulating capital. So if regulating capital is something with a star, then the regulating capital in industry M and the regulating capital in industry N will be roughly equal to the average regulating capital. And that follows again from the logic over a period of equalization. What Marx actually calls that period a cycle of fat and lean years, which he observes, because they're all talking about real phenomena, takes place in different industries with different dimensions. Obviously, an industry that can expand quickly will have a short cycle. Industry that expands slowly will have a long cycle. It takes a long time to build a steel plant. It takes a short time to set up a shop to run photocopies. So you can expect the process will be different in those two. It takes a long time to grow trees. So that would be a long cycle. But these are characteristics of the industry and of the technology involved. And so therefore they're quite concrete. That means that because this process of equalization, we don't expect to see equal profit rates even for regulating capitals. We expect to see them shooting back and forth. So if I stop the picture at any moment of time, the regulating capitals will be unequal. And that tells us something very important. You cannot tell whether there's an equalization process by looking at one moment of time or even 1 year. You need to look at it over time to see if they cross back and forth. So that crossing idea is very important. So you don't expect to see it one moment at a time. And we already said profit rates are not equalized across countries because their regulating capitals are not the same thing as the countries. And lastly, is it lastly? Maybe there's one more. Some more? Yeah, no. Next, industries with higher capital intensity will have higher regulating profit rates. That's this whole point here. If profit rates are equal, If the capital intensities are higher, then profit margins are going to be higher. And lastly, I said the adjustment process takes different times for different industries because it depends on the technology that they're using. That means that the entry takes longer, but the exit also takes longer because you have capital tied up. I mean, if you are entering shipbuilding, you'll go through cycles where you want to build more ships, and they take a lot of time and very expensive. You're talking about tankers, extremely expensive. But when that cycle comes down, you don't just sink those tankers. What you do is you reduce the capacity and take your hit, first to speak, in the utilization capacity. You run them less often because they're very expensive to build again. On the other hand, if you're talking about photocopy shops, if it turns out there's not much demand for the shop on the corner, you close it down because they're very easy to duplicate. And so they go in quickly and they go out quickly. Now, the implication of that is the following. Competition will be more price sensitive where you can go in and out quickly because supply can expand quickly. And it'll be less price sensitive and more utilization sensitive where it's slower. So the slower the entry and exit because of the cost of it, the more you'd expect to see adjustment through capacity utilization rather than through price. Not saying you won't get adjustment to price, it's just that the first hit is always capacity utilization, and in an industry with a lot of costs of entry and exit, you're going to see much more fluctuations in capacity utilization and less in price because the entry and exit is slower. Okay? So now we have the setup, so to speak, for the list of properties, and we can go down to talking about the empirical evidence. So to do this, I first want to bring out an important point, which is that we observe that when industries, when firms come in, when there's a new firm coming in or new capital coming in with lower technology, it typically will, as Marx puts it, makes its presence felt, announce its presence by lowering prices. But lowering prices doesn't mean that everybody's going to match that price. It does mean that they're all going to try to lower theirs if they want to keep their market share, but they don't have to lower it all the way. So one implication of that is that we would expect to see that the firms which are the regulating capitals, let's say it's D, would come in and have the lowest price because it has the lowest cost, but the others may not match that. They may cut their costs, their prices in relation to their costs because this one, for instance, is the highest cost. It's doomed anyway. So they may not even bother to try to defend market share. They're on their way out. These may defend somewhat. These defend more, and these are the ones regulating. So you then get a kind of relationship between price and costs in which prices would be linked to costs because the ability to cut your prices depends on your costs. So again, this follows from just the dynamics of competition. Any questions about this? That means that profit rates would be, profit rates depend on how much you cut your price and what your costs and capital margins are. So you could expect to see a spectrum of profit rates which are different, and even the new producer may even have the lowest profit rate because they're expanding market share so they can make up for it, so to speak, well, for a low profit rate with the rise in volume. So now it's useful to look at the data. And this is a study. So first thing we observe when you look at the empirical evidence, and an example is this article by Paul Gorofsky called in 1990 called Modeling Persistent Profitability in a book by Mueller. Mueller is a sort of leading economist who does work on profit rate differentials, on Austrian economists. And he finds the following things when he studies how firms actually behave. One is that when there is excess profit in an industry, it stimulates the new methods of production in the industry, and new methods not only by new firms coming in or some capitals, but it forces an effect other firms to adapt to that by changing their technology to keep their place. Firms coming in with new methods undercut prices by existing firms. And in fact, he finds empirically that even the threat of entry is enough to persuade firms to cut their prices, to forestall, or at least to prevent their loss of market share when the new entrants come. And the possibility of threat of entry may even lead them to adopt a new method because they know the new entrants are going to come with a new technology, and they may decide to adopt the new weapons, so to speak, the new arms in order to. So all of this process, he points out, empirically tends to remove the excess profits. It doesn't have to be from new entrants. Even the threat of new entrants can do it, as firms try to prevent losing their position. A second article, which is really interesting, is by Damon Darlin, which is an article in the New York Times in 2006. And he talks about how competition is characteristically price-cutting behavior. I bring this up because in neoclassic economics, competition is price-taking behavior. And he's observing the actual business behavior, which is what Gorosky was doing in the previous thing I cited. And here's some quotes. Price-cutting behavior is characteristic of competition when there are substantial cost differentials. That makes sense. If everybody has the same cost, there's no advantage for price-cutting. You just, everybody's hurts everyone equally. But if there are cost differences, then the person with the lower cost has the advantage and can make use of that. And he gives an example of Dell. Everybody knows Dell computers. Dell was actually a publisher of books, paperback books, in the olden days when King Arthur was alive. But now it is a publisher. It's principally a computer. And he says, Dell is sharply reducing prices on its computers. The tactic is classic. Lower your prices. Profit margins will take a temporary hit, but the move could hurt competitors worse as you take market share and enjoy revenue growth for years to come. I'm quoting here. Quoting again. Dell did this in 2000 and it worked beautifully. He says firms with lower costs can cut prices, take market share from their competitors, knowing if they are successful, the temporary hit, that's his phrase, in their own profits margins will be compensated by revenue growth for years to come. A third study, a characteristic study, is by Bryce and Dyer in Harvard Business Review in 2007, and it's called Strategies to Crack Well-Guarded Markets. And here's what they say. They conduct a 4-year study of the most profitable industries measured by return on assets between 1990 and 2000. And they say, quote, our 4-year study left us with no doubt that money attracts money. In the decade that we examined, the most profitable industries had almost 5 times as many entrants as did the average industry. So that's a key point in the argument of real competition. Higher profits attracts new entry, 5 times higher. However, fresh entrants into the most attractive markets earned returns that were 30% lower than those earned by newcomers in other industries. So here's an interesting point. Industry with high profit rates, they rush in, and yet they end up earning less money than in industries with normal profit rates, 30% less. Yet, when entrants into the top industries were profitable, they won big. Their returns were nearly 7 times those of all entrants in top industries, and almost 4 times the return of profitable entrants in less attractive markets. So what happens is the lure of high profits is also high risk. The ones who win, win big. The average actually doesn't win because there's a lot of competition, much more intense. They lose, they die out more often than industries where profits are less high. But the lure is very big. And so you get 5 times as more people coming in, or more firms coming in, into those markets.
Who developed the Yogi Berra?
Pardon?
The Yogi Berra theory.
Well, I don't know about that, but it's a Harvard Business Review theory. So they are, maybe Yogi Berra was really went to a.
It says if you come to a fork in the road, take it.
Yes. Yeah, well, here is a fork in the road which has a lot more money, and then you end up losing money. But you take it anyway because you can make a lot of money if you do make it. So he says, industries where existing player profits are consistently higher than those of enterprise and other industries find that entrants are drawn to those markets like bees to a honey pot. Moreover, almost without exception, the challengers, the new ones coming in, take a page out of a military handbook. It's a point I've been making throughout. Competition is a kind of war, real competition. Here is an example of how you announce that this is a war. Virgin Cola, everybody knows Virgin Cola, I guess. I don't drink it myself, but it's a kind of cola. At their US launch, Virgin Group CEO Richard Branson, of Virgin Airlines CEO, drove a tank through a wall of cans in New York Times Square to symbolize the war he was planning to wage on rivals. Red Bull, which is another cola company that operated in a different kind of war style by stealth. It entered the US soft drink market in 1997 with a niche product, a carbonated energy drink, retailing at $2 for an 8.3 ounce can, twice at what you would pay for Pepsi or cola. But it designed its can to be tall and narrow, and so retailers could stack them in smaller spaces, and it sold them in outlets such as bars, nightclubs, and then after it got a loyal following, it was able to elbow itself into the corner store where it now sits next to Coke and Pepsi. So it kind of stuck in the United States, where Red Bull enjoys a 65% margin, 65% share of the $650 million energy market drink in 2005. And it came in from the outside, whereas Branson comes in by driving a tank through, so to speak. Those are different strategies in warfare, as you know. Gilad, who was an author of a book, offers to reveal various techniques of wargaming for which companies have previously paid large fees. He says, in a global market, in a global, complex, and competitive world, developing a plan without testing it against market reaction is like walking blind into a minefield. Wargaming is a metal detector for a company. Yet war games run by large consulting firms are kept secret and cost millions. For the first time, this book by Gilad makes them accessible to every country, no matter how small, or every company, no matter how small or large. He says, quote, "This book is your Bible on how to stay one step ahead of your competitors. Do not leave home without it." So in case you're planning to go into business, I can give you the citation so you can get the book. Okay. Another study by Foster. This is an NBER working paper in 2005. They look at 17,669 establishment level observations for producers of 11 distinct products. So they look at fairly homogeneous products, a large sample, close to 18,000, and they find the following thing to be a general result. More productive businesses displace less productive business. Businesses with higher productivity and hence lower costs tend to displace businesses with higher costs. Less physical productivity, lower productivity is associated with higher probability of exit. What is that saying? If your costs are low, you will be displacing firms with higher costs, and therefore firms with higher costs have a higher probability of exit, of being driven out. Lower cost producers grow faster, are more likely to survive. They charge lower prices than their incumbents. And they charge prices so low that their prices maybe match their lower costs, so that their price to cost ratio may be the same. In other words, they lower their price in close proximity to their lower costs, and that means that you wouldn't observe the lower price by comparing cost to price, but cost per unit output you can compare. And since they're looking at a sample of roughly homogeneous firms in 7 different industries, they can actually distinguish productivity from cost to price ratio. Is that point clear? I'm not sure it was. Maybe I should do a little illustration of this. So let's say that you have firm 1 and firm 2, And here the cost, unit cost, this is 4 and this is 2. We know that the firm with the lower cost has a big advantage because it can cut the price. So let's say this price was, I'm just going to make up a number here, 8 is price. If the firm cuts the price to 4, then it has a big advantage in the market. But notice that the cost per unit price in this example is 1/2. So by looking at this ratio, you won't be able to tell who's got lower costs. You have to look at the actual cost per unit product, because typically firms with lower costs lower their prices, and so there's less of a difference between their cost-price ratio, what I call the cost margin, than there is between their unit costs. Now this is relevant because we're going to be looking at data, and we want to be able to distinguish between firms that have lower costs and firms that have lower cost margins, the cost per unit price. Okay? So if you look, and this is what this example was about, to say that if firms have lower costs, part of that difference in lower cost will be reflected as lower price, so the cost to price ratio will not be as different as the cost to output ratio. Okay? So if you look here, the cost margins are very close. The cost per unit price is 0.82, 82, 83, 87, whereas if you look at the unit costs, they're much more different, 82, 80, 78, 76. And it's even possible that these cost margins will be roughly equal because prices are cut in proportion to cost. So with this, we can go to some empirical evidence. Yeah.
Just a quick question. And maybe we will get into this when we talk about empirical evidence, but how often are firms, I guess I'll use this word, how often are they violent in this way? Like how often do they actually lower their cost, lower their price down to the unit costs? I mean,
no, they don't. Yeah, they're not down to unit cost. Remember, they're proportional, but here's unit cost 2, and this is 4. So the question is not that they lower to unit cost, though sometimes they do, by the way. They do that to drive out everyone else. They come in and they lose money in the beginning to make a point, but they don't have to. Or they just have to drive the price down. So let's say they come in, let's say this is the new firm here, coming in at a cost of 2. Now, if the original price was, let's say, 8, this firm comes in, sets a price at 6. The firm that is a higher cost may have to go to a price of 7 just to keep its customers from walking away. It's got established customers. It takes time for them to bleed out and all. So what you're going to observe is that prices will go down. But then the ratio of cost to price will be different, will not be as big as the ratio of cost to output differences. Because there'll be some adjustment here. And that's because when we observe prices across firms, we see that firms have different prices, in partly because as new firms come in, they lower their price, but they don't go all the way. Because your customers don't walk away immediately because there's a new price. They tend to bleed out. And since they bleed out, it depends on how long you expect to stay in the business in the first place. You know, with that technology, you may want to just let some of them go out and jump to a new one, though most of the evidence is that if you can, and you're not bearing too high a cost because you're wiping out a plant and equipment that's still operating well, you'll lower your price and keep it going until you switch to the new technology, in which case you'll be the leader and someone else will be the middle level. So it's a leapfrogging kind of thing. Again, you can see from warfare, it's absolutely, you can't throw away your weapons because you don't have the best ones, but you definitely want to try to get the next round of be there to play the game. Okay, so now some more evidence. This is a study by, yeah, it does. I just want to make sure that I'm caught up with it on my, as I said, my staples fell out, so the papers are kind of 11, 12, here, 12, okay. Okay, before I get there, I am now ready to explain the difference between the argument I've been developing so far, which is real competition, and the argument in perfect competition. Why is it important? Because if you look at this data from the point of view of perfect competition, you're going to see it doesn't exist. But if you look at it from the point of view of real competition, it might be perfectly consistent with it. So let me remind you of the theory of perfect competition. In the theory of perfect competition within an industry, all firms are alike. If they're alike, they all have the same cost. Competition gives them all the same price. It follows that within any industry, all firms have the same profit margin and the same capital intensity and the same price and the same profit rate, therefore. Is that clear? Now I go to another industry. So this is the industry producing corn. I go to the iron industry. Again, all the firms are exactly alike. Prices are exactly alike. Costs are exactly alike. And profit rates are exactly alike. So again, within each industry, they're alike. But because the profit rates in this industry are all alike, let's say they're 15%, and they're all alike here, they're 12%, competition between industries will bring them to a common profit rate. So this industry will end up with 13, and this will end up with 13. So that means that in perfect competition, every firm in the long run will have the same profit rate as every other firm. Is that clear? Should I do that again? No? Okay. The point of that is then you can study whether competition exists, if you believe this framework, by taking any firms from here and any firms from there and any firms from anywhere else, because from the theory, all firms should have the same profit rate. Now, it doesn't take Harvard Business Review to tell you that firms don't have the same profit rate. And then the question becomes, is the differences among profit rates evidence of absence of competition, or is it evidence of the absence of the failure of the theory of perfect competition? I'm obviously arguing the second point. Okay? So, typically, when people began to study, and I'm going to devote the next lecture to this, the detailed studies of theories of what are called industrial organization theory. Industrial organization theory arose from the observation that the data doesn't match the theory. And so the question was, why not? And the most simple and ready answer seemed to be because there was no competition. Well, what's the absence of competition called? It's called imperfect competition, monopoly, collusion, oligopoly. So they began to look at market power, collusion, barriers to entry, differences in efficiency, which are already proof of imperfect competition, because in perfect competition, all firms are alike. There are no differences in industry efficiency. And then possibly maybe that capital stock wasn't measured properly. Accounting stock was different from economic stock. Maybe they didn't take into account intangible capital due to research and development and advertising. Everything was tried. None of this was successful. Industrial organization is a wonderful field because you can keep on doing studies showing how the theory of perfect competition doesn't work, and you'll get a job and get promoted and get tenure because it's an industry like behavioral economics is today, showing that assumptions of standard behavior don't work. But the question really should be, what does work? And the answer is not oligopoly and monopoly. We show again and again that it doesn't work. And I'm going to devote the whole lecture next time to oligopoly, monopoly theory and empirical evidence. But for now, I want to talk about some of the studies and how consistent they are with the theory of real competition. Here's a study done by Dhawan, Rajiv Dhawan, in 2001 in the Journal of Economic Behavior and Organization. And what he did is to study the relationship between firm size and productivity differentials. One of the things he finds, he says, and he says it's true of almost all studies, is that profit rates are smaller for bigger firms. Now that's already inconsistent with oligopoly monopoly theory because bigger firms are supposed to have market power. But it's perfectly consistent with the theory of real competition because price cutting is how the bigger firms enter the market, and you can end up with a smaller profit rate, but you get an expanding market share, so it's perfectly fine. And that was a point of the studies I read by Bryce and all these others. That's what firms do. However, what he also finds in his study is that larger firms have significantly lower levels of risk. So they have lower costs, they have lower risk, but they also have lower profit. He takes a CompuStat file consisting of, ultimately filtered down to 935 publicly traded firms on the US Stock Exchange from 1970 to 1989. And the principal finding he has is that the average profit rate is lower for bigger firms. So here's the firm size. These are in millions or billions or whatever. I think millions. Yeah, millions. So firms from 0 to 25 million are small, called small firms. 25 to 250 medium, 250 to 1,000, and extra large over a billion. The profit rates consistently go down with firm size, so bigger firms have lower profit rates. The variation of profit rates goes down also. Coefficient of variation goes down. So, and what's striking is the failure rate goes down sharply. So if you adjust profit rates for risk using the failure rate, so probability of failure, then you can, the adjusted profit rate is calculated as a mean profit rate, which is this one, times 1 minus the survival probability, which is 1 minus the failure rate, and you get profit rate differentials are much more modest. They're roughly on the order of 10 to 11% here, which is another way of saying that the lower profits of big firms, lower profit rates, are compensated by their higher survival. Okay, so this is a kind of result that is perfectly consistent with the theory of real competition. Now, I then looked at CompuStat data for the US and Canada, and what I did was take a sample of non-financial companies. The sample size was 38,948, so it's a pretty big sample. All variables were converted to constant dollars because we're comparing over time and you want to take out the effect of inflation. And what I did was regress the rate of return and profit margins and cost margins, capital intensity on the size of firms, the size as measured by their capital stock. So the bigger firms had certain characteristics, and this is summarized in this table here. Capital intensity rises with firm size. The bigger firms are more capital intensive. That is to say, they have higher capital per unit output. Cost margin doesn't change very much. Bigger firms have the same cost per unit this is capital per unit sales. Capital per unit sales, and it rises with firm size, but costs per unit sales are roughly stable. And this is because lower cost firms have lower prices. So their sales price is lower, and so the cost per unit sales is roughly the same. The profit rate is lower for bigger firms. Again, because the price cuts make it possible for them to dominate the market, but that makes their profit rate lower. It doesn't mean that it's negative. These are elasticities. So that means that as firms get bigger, they get more capital intensive, their profit margins don't vary very much, and their rate of profit declines with firm size. It's exactly the same result as in Taiwan, only in my case it's a much bigger sample. And it has a strong implication, which is that this one here of capital intensity rising with firm size is very consistent with the argument coming from the classical tradition that the way that firms cut their costs is raising their capital intensity. That capital intensity, getting bigger plant and equipment, more mechanized plant and equipment, more capital per unit output is the way that you lower your costs. So it's a trade-off. you get a lower cost in return for having higher capital intensity. Is that point clear? It makes perfect sense. Usually if you have, say, a lower cost computer production, typically the scale expands from price of output, your sales. But that allows you to lower the costs, and you come in there and you can take the market share. Yeah.
We're mixing all kinds of industries here with different
Yes.
cost structures
Indeed.
from the get-go.
Yes, indeed.
So you're collapsing it all into one super aggregate.
Well, it's a sample. So yeah, so if the other people do studies by industry, I'm skipping some of those, but they're in the book. We know that productivity differences by industries can be identified. And I did mention some of those, Gurowski at the beginning. But here I'm interested in the broad properties. If I go across a sample of 39,000 firms for 10, 15 years, I find this a very robust result. So it's reasonable to say that in general, the way that costs are cut is by becoming bigger in size and more capital intensive in size. And the reason that's important will come at the end when you'll see that this has a tremendous implication for the movements of the general rate of profit, the average rate of profit.
That a lot of these firms will have a larger and larger service component. There will be less hard capital per sales dollar over time. You've got, you take the General Electrics of the period. They're industrial companies, but if you look at them in general, they become, in that same period you looked at, more and more service oriented, the more the finance started in General Motors' case to outweigh the industrial segment. So you're aggregating a massive conglomerate group here by industry,
But here the firms are partitioned according to their product. CompuStat does that. So it doesn't take General Electric as a single firm. What it does is it takes all of its different products and it partitions it. And that way you get around that difficulty. If you're doing it by firms, you're absolutely right. But this is by product. I should have mentioned that at the beginning. CompuStat has a lot of data. And not all the partitions work. Sometimes firms don't give you the information. But we cleaned up the data as much as we can. Yeah, it's a good point. Okay. So far, I've mentioned that these are results that are quite consistent with the theory of real competition. And I need now to move to what the empirical evidence is on profit rates across sectors. And to do this, the intermediate step is to point out that neoclassical theory and even Sraffian theory on one side and the theory of real competition on the other side have a very different treatment of the distinction between new and old capitals. This is a seemingly arcane point, but it's very important for the theory. First of all, in neoclassical theory, I already made the point, there are no differences. If you're an industry, any firm is representing the whole industry because all firms are alike. Therefore, there's no difference between the new firm coming in, or where new capital comes in, the regulating capital, and any other, because every firm is a regulating capital, and the same in the other industries. So there won't be any difference between profit rates of new investment and average, and for that reason, I don't need to look at new investment, I can just look at the average. Because within the theory, the average is representing the new. Is that point clear? Sraffian theory does it in a different way, but it's essentially the same conclusion. Sraffa's theory allows for plant and equipment to have vintages. So he says, okay, if I have an industry and they have different vintages, and the vintages are in effect older or newer, and so they'll have different profit rates. But how do you measure the profit rate on a vintage? I look at the amount of profit, and then I need the capital stock. And Sraffa says, well, we use a standard formula in neoclassical theory that the capital stock will be calculated in such a way that it has the same profit rate as everyone else. In other words, if the capitals in the back are older vintages, then they will be assigned a smaller amount of capital value, just enough to make them the same profit rate as the newest vintage. And that's essentially present value discounting. That's what that does. It's a way of assigning capital value so the rate of return is a common rate. The trouble is that empirical measures of capital stock are not like that. And indeed, there's another measure called gross capital stock, which is perfectly consistent, but it is the cost of the firm kept on the books of the plant and equipment when you first bought it. And the reason, this is Marx's argument, why do you want to do that? When I buy plant and equipment, Marx points out, as the machine gets older, it depreciates. So it's worth less. But the profit rate, what you're getting back as the machine depreciates, depreciation allowance. So your capital value is not changing. All that is doing is changing the form from a machine to money. So you start off with money, you invest $10 million in a business. Over time, as the machines age, the machines are worth less and less until you scrap them. They're worth nothing at that point, or just scrap value. But you're still getting back the depreciation allowance, so your capital value remains the same throughout the life of the machine. This is called, in national income accounts, gross capital stock. And this is a different measure of calculation of capital stock. It can be done as in SRAFA with joint products and all of that, but it doesn't change the fact it's a different measure. So we have two different measures. The question is, what should you calculate the rate of profit on? If you follow the standard methodology, you calculate the rate of profit on the net capital stock, the machine as it depreciates. And that depreciation is calculated in such a way as to make the profit rate the same. So if I have a new machine here, the profit rate is 10%. The old machine, if I calculate on gross stock, the profit rate is 2%. But if I calculate it on just the value of the machine, not the depreciation allowances, then the profit rate is 10%. So I just take the remainder of the value of the machine and I make it such that it gives me the same profit rate. So it's pretty simple. No empirical evidence is calculated in this way because businesses don't do that. But I would argue, more importantly, you shouldn't do that, because what that does is mask the aging of the machine and mask the decline in its profitability by making it seem as if it had identically equal profit rate until it dies. Is that point clear? So if I do this, the standard methodology, I take a new machine and an old machine, and I devalue the old machine until the profit rates are equal, whereas in the classical methodology, the new machine will have one profit rate and the old machine will have a lower profit rate, other things being equal, because it's less efficient at an older point. So the problem with the Sraffian argument is precisely that there is no distinction in the Sraffian or neoclassical theory between profit rates of old and new investment, old vintages and new vintages. But when you come empirically, of course there's a difference, because firms do not price their machines to make their profit rate the same as others. In fact, on the contrary, they keep the machine price at its book value, what they paid for it, and they observe that its profit margin and profit rate is shrinking, and when it gets to the point where it's not worth keeping alive, they close it down. So that falling profitability as you age is a signal for scrapping. It's called the scrapping margin when it reaches something close to zero. So we need, if we're going to talk about the classical argument, we need to distinguish between the profit rate of average capitals and the profit rate of new capitals. Now, one way to do that, and I don't have time here to go too much into it, but just to explain the logic of it. If you think, then you add a new capital, what you're doing is you're adding to your profit. What's the cost of that new capital? That's your investment. So the rate of return, the current rate of return on a new investment is the current new profit divided by the current new capital, which is the change in profit over investment. In other words, the incremental rate of return is an approximation of the rate of return on new investment. Not the rate of return over its lifetime, its current rate. Whether it's equalized over a lifetime, we're going to see. But you can measure the rate of return on new investment in this way. I actually do it in a little bit more complicated way, but you end up with this as a very good approximation. And the basic idea is fairly straightforward. We want to separate out the profit rate of the new machines from the average profit rate, because we don't expect them to be the same. They might be, but they're not taken for granted to be the same, so I need a different measure. So that measure is the incremental rate of profit. So we're going to be looking at the rate of return on investment, which is approximately equal to the change in gross profits over gross investment. I use gross profits for a reason, because then you don't have to worry about all the arcane ways in which they calculate depreciation. And gross investment, because it's a published figure, it's not adjusted. So you don't have to deal with the adjustments for depreciation, which are, by the way, quite problematic. And it's a measure which is widely available across countries, across time, across industries. And the hypothesis is that these profit rates in industry I are roughly equal to the profit rate in industry J of new investment. And that's a classical hypothesis. That's the fundamental hypothesis, because these are the regulating rates of return. Okay? So now we want to see what happens when you look to see the difference between average profit rates, because the argument here is that the average profit rate is not equal to the average profit rate in one sector. So that's one hypothesis, and the second is the incremental or the regulating rates of profit are equalized. That was part of my list of properties, of necessary properties of competitive firms, of real competition. So here is data on average profit rates done by a former student at the New School, Christodolopoulos. And these are, we got the data from the OECD, International Statistics Database. And these are profit rates on industries across the OECD. So each industry is defined across the OECD, and we're now looking at it over time. So it encompasses industries in different countries. And what you can see is that these profit rates, the list of industries is down at the bottom. I'm not going to read it for you, but anyway, there's a bunch of industries, textiles, paper, certain kinds of manufacturing, and so on. And we were able to get data from 1970 to 1989. It was a lot of work in those days to do this, by the way. And you can see that profit rates do not cross over. They stay within some range of each other, but you don't see them crossing over. Is this point clear? Can you see this? Now look what happens when you take the same industries and you look at their incremental rather than their average rate of return. And you can see the tremendous amount of crossing over. That little step to try to figure out the difference probably took me 12, 15 years just to think of it. But once we did it, it was really beautiful because it kind of leaped out. I did it actually originally for the stock market and the corporate sector, and I'm going to come to that in another lecture. But once we got the idea of looking at it across countries, the question was, where is their data? And this is exactly the kind of turbulent equalization that you would expect. Now, this was the first one we did a long time ago, 1990s. I subsequently did manufacturing rates of profit in the United States from 1960 to 89. This data is available on BEA website. And again, you see the average profit rates are close to each other, but they don't cross over. You can see ones that stay far away, and you see a lot of clustering, so they're not unrelated to each other, but they're not equalized either. And this is the foundation for all the studies trying to explain why profit rates are not equalized. But here, for the same set of industries, are the incremental profit rates. And you can see the tremendous amount of crossing back and forth. The incremental profit rates are very spiky because a change in the profit depends on lots of local factors. One could smooth it and HP filter it and all that. I haven't done any of that, but you can see that that's not going to alter the result. I'll show it to you more concretely in a minute. Any questions about this? So now further, I then proceeded to look at average data for average rates of profit from 1987 to 2005. And again, these are on the BA, and you can see that they don't really cross. There's some that stay far away, but they, on the other hand, they sort of run parallel, the average rates. And that's not surprising, because the average rate is a mixture of new and old technologies. No reason why the old technologies should have the same profit rate in one industry and another? No, because when you look at, I'm sorry, let me get to that point, Andy, but here's the deviations of the average rate from the industry average. And here you can clearly see each one of these. You can't see it all, but anyway, I can take my word for it. Let me see if I can make it bigger. So you can at least see some parts of it. Yeah, some of them. See that? Can you see that better? Here's a straight line, which is the average. And here's one industry, which is accommodations. And you can see it barely touches the average. Mostly it's below. I don't even know what this one is. Here's administration and waste. Amusements, which are above. And so you can see that they don't really cross over the average very much. Different ones, electrical equipment, and these are all average rates relative to the average of the average. Now, look at the difference here. These are the incremental rates of profit for the same set of industries now. All I've done is change the measure. And you can again see this tremendous crossing back and forth. And you can see that crossing more concretely if you do it by sector, industry, one industry at a time. So, can you see that? Chemicals crossing over, and you can see this crossing back and forth in different industries. Here's the average, and you can see clearly across industries, industry by industry, a huge amount of crossing. Not everything, not everybody, but a very large amount. This is a paper from Sulfides and Saliki, which is in the Greek manufacturing sector. And you have average profit rates, which again don't cross over that much, so they stay within the bounds. And then you have incremental profit rates, deviations from the average. And again, you can see here's the average, and you can see these crossing. Here's the average, you see the crossing. Here's the average, you see the crossing, and so on. I'm sorry that looks so bad on the screen, but Macs don't like graphs made in Word. Here's another set of data, which is incremental rates of return from the OECD. I updated the data. The OECD, unfortunately, doesn't publish capital stock data anymore. So we couldn't do this for average profit rates, but it does publish investment data, so we could do it for incremental profit rates. And again, you can see the tremendous amount of crossing back and forth. So I argue, I've been arguing for a long time, that the incremental rate of profit is a proxy for the rate of return on new investment. And you find, and by the way, even now the, I think it's Eurostat that has now adopted that notion of the incremental rate of profit as a measure of profitability. Because you can see from a marginalist point of view, it's the marginal rate of return, right? And what I'm arguing is that that's exactly what you find equalized, the incremental rate of return. This is word for word what Keynes talks about when he talks about the marginal efficiency of investment. He says the new profit created on the new investment. And that's basically what I'm measuring. Okay? Any questions here? So now I want to put all of this together in a different issue, into a different issue, which is to say, what are the forces that determine the decision by firms to adopt new technology? And how can we characterize those decisions in the aggregate? But I've already made the argument for what are the primary variables. I've argued that firms are driven towards technology that can lower their costs, because this allows them to compete more effectively, to destroy others more effectively, to increase their probability of survival. It doesn't guarantee anything, but to increase the survival probability. So you can think of it from an evolutionary point of view, in a Darwinian sense, that this is a strategy that increases the probability of reproduction, of survival. And many people Mariano Mazzucato, who's a former student of ours, who actually took this course in an earlier incarnation, is going to be giving a lecture on October 28th on the role of the state in helping firms prosper and grow. But she did a lot of work on evolutionary economics, which is a theory of how firms compete viewed from an evolutionary point of view, not from the point of view of perfect competition. And what I'm saying is very consistent with that. So now I want to link these arguments to the question of what's called the choice of technique, which is the conditions under which firms choose new methods. And I'm making a specific argument, but to do this, I need to just go a little bit into algebra. The profit rate of a firm is its price minus its unit cost, price per unit output, cost per unit output, divided by the capital stock per unit output. That's just straightforward. Price minus cost is a profit margin. Capital stock per unit output is a capital intensity. We did this before, right up there. Okay? Everybody with me? If I divide through by price, then I get 1 minus the cost margin, the cost per unit price. And in the denominator, I get the capital margin, capital per unit price. Or if you want, capital per sales. So this is cost sales ratio, and this is the capital sales ratio. Why do I do it that way? Because we have data on that. But also it gives a very nice implication, because we found, if you recall, well, let me come to that. Let me save that a little bit. So now, one way to characterize the issue of the choice of technique, suppose that this is a change in the capital intensity, a positive change in the capital intensity, and this is a negative change in the capital intensity. This is a positive change in costs and a negative change in costs. So let's suppose that this set represents all possible technologies available at any moment of time, and it's neutrally spaced in the sense that there are technologies that will give you higher costs and technologies will give you lower costs. Some will be more capital intensive and some will be less capital intensive, right? So if there is no relationship between costs and capital intensity, then the space is neutral. And since firms have to choose lower costs, they will cluster on average here. This part will be the region which is feasible because it's cost lowering. And if you're lucky or randomly, it could be lowering capital intensity or raising capital intensity. Everybody with me here? So the center of that set is here. So if these are random, otherwise random possibilities based on local factors, we'd expect that the average would be cost reducing but no change in capital intensity. So if the set is perfectly general and is not, there's no relationship between capital intensity and costs, on average, then you'd expect to be here. So you'd have neutral, no changes in your capital sales ratio, and costs would be reduced. You can think of this as this point here as Harrod neutral technical change, and you'd have cost reduction from the theory of real competition. But remember, one of the key arguments made by Marx, but also by others, is that Salter and others is observing industries. They observe that in order to lower your costs, you need to raise your capital intensity, because the way you lower your cost is going to bigger technology and bigger plant and scale on average. You could be lucky and lower your costs without doing any of that. But on average, there is a cost to lowering the cost, and that is your higher capital intensity. That's a price you pay in order to get your costs down to be more capable of survival. Very common argument in evolutionary theory, by the way, that survival characteristics are more costly in terms of energy and so on, but they have other benefits. But the argument in the classical tradition is that this set is not neutral because, generally speaking, you have higher costs, higher capital intensity associated with lower costs. In other words, the set is biased in the direction of higher capital intensity to lower costs. It doesn't say everyone. Here's a set of all possible technologies. Here's the feasible set, because it's a set that reduces costs. And if that set is also the one that raises capital intensity, then you're going to be somewhere in the center of that set. So this is a methodology developed by Duménil and Levy and adapted by Foley and then myself. So that implies that the average will be cost reducing but capital intensity increasing. Now that's what we observe empirically. That's why I came to it by looking at the empirical evidence. But this is a simple way to explain why that's so. It doesn't say that every firm will do it. It says that the average firm will do it.
You're basically saying intensity goes with cost reduction as a general rule?
As a general rule, and that's what I showed with Dawan and all those other studies, is that, and my own empirical CompuStat data, but by and large, capital intensity goes up as cost goes down.
Cost of the capital.
Cost of capital goes up as the cost of production goes down. Yeah? So now there's an implication of this, which is relevant, which is that we can say that if this is so, then we can tell you something about the path of the profit rate, other things being equal, from technical change, from this kind of technical change. So let's suppose that we have unit costs are modeled in such a way that they go down over time. This is to show you the general drift of the story, right? So I had here, at this point, the change in unit cost is negative, which means they're going down. And at this point here, because the axis here, the capital intensity change is positive, so it's going up. So we want to see what the effect of reducing unit costs and raising capital intensity is on the profit rate. And if you read Marx, you'll recognize that's one of the central arguments in Marx about the determination of the path of a falling rate of profit. So one simple way is to say unit costs decline. So unit costs are some initial cost times 1 minus a coefficient, which is less than 1 and positive. So this number is less than 1. As it becomes bigger over time, unit costs shrink. This is a way of keeping the unit cost a positive number by capturing the idea that it's falling over time. Reverse capital intensity is its initial times 1 plus b. B is a positive number. And that number being bigger than 1, since b is positive, it will rise over time. So we have unit costs falling over time, or cost margin falling over time, capital margin rising over time. Well, the profit rate is just 1 minus the unit costs over the capital margin. And if we substitute here for the unit cost, this declining term, and for the capital margin, this rising term, then I can simplify the expression so that I get in the numerator, I get 1 over 1 minus a raised to the t power, and this is a rising number. Since 1 minus a is less than 1, 1 over 1 minus a is bigger than 1, so this number is rising. And here you have a fixed constant, which is going to drop out of the picture because it's being divided by something which is rising over time. And this thing in the denominator is 1 plus b over 1 minus a, and it's a bigger number than 1 over 1 minus a because 1 plus b is bigger than 1. So you're going to have a numerator which is rising asymptotically at this rate, and the denominator which is rising asymptotically at a higher rate. And so therefore the profit rate will be pulled downward. This is almost exactly the the formulation of the verbal argument in Marx about the effect of a rising ratio of dead to living labor, capital intensity in Marxist terminology, over time on the path of the profit rate. And notice it does not exclude the fact that costs are falling, and therefore, in Marxian terminology, the rate of surplus value is rising. This is a process in which the rising capital intensity dominates. And you can show it for yourself. This is a simple spreadsheet example. You could do it in 10 minutes, 3 minutes, if you know how to use data or whatever. And if you do that, you'll find that there are really only two possible paths under these assumptions. One is that the profit rate will rise for some time and then fall, and the other is it'll start falling right away. Now, these are meant to be abstract analyses of the pressure put on the profit rate from a rising capital intensity. But if you recall, I showed you in the data on the United States, that is precisely what you find, a rising capital intensity. And it does put a downward pressure, which is offset, and we're going to come back to this in the last lecture in the course, so we're going to talk about these movements, which is offset by a change in wages, a reduction in wages relative to productivity, which counterbalances this effect for some time, not forever. Okay. So we've gone all the way from the discussion of the theory of real competition to empirical evidence on how firms set prices and cut costs and increase their capital intensity. And then we've drawn out the implications of a rising capital intensity, which you notice here is driven by the fact that firms need it to cut their costs. So it comes as from the imperative of competition. It's a choice variable only in the sense that if you're in a war, you have to choose whether you want weapon A or weapon B, and if weapon B has a lot more power than weapon A, your survival probabilities are much greater if you have weapon B, other things being equal. So you choose weapon B or die, but in that sense, it's a choice. But in a stochastic and in a sense of compulsion, the drift is in that direction. And this is exactly the kind of logic that appears in the discussions of a falling rate of profit. It's a process driven by the logic of the system itself. That's true of Smith, where the falling rate of profit comes from competition. It's true of Ricardo, where it comes from the expansion of land rent, which squeezes profitability. It's true in Marx, where it comes from this idea of a rising capital intensity. And it's even true in Pigou and Keynes for different reasons, but they all talk about it as a general drift. Not meant to be ineluctable, because you can change it, but you can't really change the decision of technology. That's a local decision made firm by firm. What can change is collectively the balance between wages and profits within limits. You can move to cheaper wages. You can move to cheaper raw materials, and that's another way of saying this is an imminent need in the system. With this eroding foundation, you always need to go to an offset. And what we want to look at some point, it won't be this semester, but next, at the end, is what does it look like in the aggregate economy. If you want to jump ahead, I have a paper called The First Great Depression of the 21st Century, which has all the data and so on. And next lecture, which is not next week, but the week after next, will be about imperfect competition, oligopoly, structural economics, structural economic analysis. And I want to argue that what they find as evidence of monopoly and oligopoly is in fact exactly what you'd expect from the theory of real competition. And we're going to look at monopoly measures, concentration and all scale and all of that. Then I'm going to go into the empirical evidence on relative prices. And that's where the issue of reswitching comes up. And if I can get to it, the answer we'll see empirically there's no support for the idea. It is an algebraic possibility, and there's now at the modern level an argument that perhaps and we find it empirically as you get a bigger and bigger matrices, these interactions that feedback things become smaller, and you get closer and closer to a kind of linear price curve, which is exactly what you find in Marx's transformation process. But we're going to look at the data in the US and across different countries, and you'll see that quite striking. Quite striking. If you have time, bone up on your theory of eigenvalues, because they play a central role in the math of this process. Okay, thank you. 2 weeks.
Okay, bone up on your eigenvalues. Anyway.
Thank you, Ann.
Yeah, hope that made a little sense.
A little bit.
Alrighty, now we're going to shut the live stream off.